small webinar about the week ahead. But before we start, allow you some time to go through our risk warning. Always bear in mind that our products are traded on the margin and carry a high level of risk, so it's possible to lose all your capital. These products may not be suitable for everyone, and should you ensure that you understand the risks involved. Also a disclaimer: the information in this webinar should not be considered as an investment advice or investment recommendation, but instead as educational material only. Now, this material is just a personal opinion of the author and yourself truly, Peter Youssef, Senior Analyst at IronFX. And clients' investment objective and risks tolerance have not been considered. IronFX is not responsible for any loss arising from any information herein contained. And please note that redistribution of this material is strictly prohibited. With no time to waste. Now, after an eventful few days, full of interest rate decisions and practically shook the markets, we're about to enter a more easygoing week on a fundamental level. The war in Ukraine is ongoing, and the negotiations for a ceasefire and resolution of the conflict seem to show a lack of progress. On the monetary front, given that the Fed's interest rate decision is already out and the statement moratorium is lifted, we expect Fed policymakers to sway the market's opinion with their statements, yet also policymakers from other central banks could weigh in. As for financial releases, we have an early start on Monday as we get New Zealand's trade data for February. On Tuesday, we have a rather light calendar, while on Wednesday, we note the release of UK's CPI rates for February. On Thursday, market focus falls on the release of March's preliminary PMI figures for Australia, Japan, France, Germany, Eurozone, the UK, and the US. And finally, on Friday, we note the release of UK's retail sales for February. And from Germany, we get March's IFO indicators. Moving now to the US dollar. And this would be the USD index 4-hour chart. In a wide sideways movement between the 99.40 and the 98. Note the bouncing during today's European session practically on the 98 support level. We tend to maintain a bias for a sideways motion, albeit we must note that the RSI indicator below the 4-hour chart is still below the reading of 50, may provide some slight advantage for the bears, but the upward inclination tends to imply that the bears are losing steam. Everything seems to be within the correction higher after the bouncing on the 98 support line. Lower than that, we also note the 97.40 providing some support here and some resistance here and here. And even lower than 96.60, which provided support here. To the upside, we note the 98.80 and even higher than that, which is also the highest level in our chart, would be the 99.40, providing resistance here. It was a beautiful capping of the upward motion of the index. And the highest level would be around 100 figure. Moving now to USD's fundamentals. On the monetary level, we must note the Fed's interest rate decision last Wednesday, where the bank, as was widely expected, decided to hike rates by 25 basis points for the first time. That's since 2018. The bank sounded confident, and it was characteristic that it anticipates that ongoing increases in the target range will be appropriate in the coming months, i.e. more rate hikes are to come. At the same time, it also stated that it expects to begin reducing its holdings of treasury securities, agency debt, and agency mortgage-backed securities at the coming meeting. It should also be noted that the economic projections, and specifically the dot plot, show that the Fed's policymakers see 6 more rate hikes as appropriate in the current year. This rate hike path could be considered as steep and rather hawkish, yet the market seemed to anticipate all of the above Hence, the meeting as such failed to provide any traction for the USD. We expect that Fed policymakers in the coming weeks with their statements could sway the market's mood, and we intend to keep a close eye over the statements. As for financial releases, we note the late start of the release of high impact data from the US. As on Thursday, we get the weekly initial jobless claim figure, the durable goods orders growth rate for February, and you can see the run chart in your screens right now. Note how practically the headline rate is on an upside, and to a slight degree also the core rate. On the other hand, on Thursday, we also get the preliminary market PMI figures for March, and on Friday, we note the release of the final University of Michigan consumer sentiment for March and the pending home sales for February. Moving now to the pound, and this would be cables for our chart. The characteristic move of the week for the pound was practically the breaking of the downward trend line guiding cable since around the 22nd, 23rd of February, with a nice upward motion which began around the 14th of March. Note the stabilization though, which is very interesting at the 1.3170. It finds substantial resistance here, and it seems that we may be in for consolidation of the price action in the coming days. Nevertheless, to the upside, we note we have mentioned already the 1.3170 providing resistance here and here. Even higher would be the 1.3275, which provided support once, twice, and as the price action now is lower, has turned into a resistance line. And the highest level noted would be the 1.3415, which provided resistance once, twice, three times in the recent past. To the downside, we note the 1.3065, even lower the 1.2990, the lowest point in the chart, and even lower the 1.2890. Now the pound is about to end the week high against the USD and JPY, but seems to be losing ground against the euro for the week. On the fundamental side, a positive improvement of the market sentiment could support the pound as it is considered a riskier asset. Overall, the news coming from the UK seemed to be on the positive side. It was characteristic that the UK employment market seemed to be tightening further in January. As the unemployment rate dropped, the employment change figure remained in the negatives, yet improved somewhat. And the average earnings growth rate accelerated more than expected, which implied that inflationary pressures in the UK economy may have been fed further. On the monetary front, BOE's interest rate decision to hike rates by 25 basis points was largely expected and tended to feed the market's expectations over the past few days. On the other hand, we must note that the bank, in its accompanying statement of the interest rate decision, mentioned that only, quote, some further modest tightening in monetary policy may be appropriate in the coming months, unquote, yet also highlighted that there are risks on both sides of the judgment. The decision seems to have triggered some bearish tendencies for the pound as the softening of the forward guidance came in contrast to the market's expectations for a steep rate hike path. As for financial releases, in the coming week, we highlight the release of February CPI rates for Wednesday, which could draw substantial attention from pound traders. On Thursday, we highlight the release of the preliminary market PMI figures for March, with special weight being placed on the services sector's reading, while on Friday, we get the UK retail sales growth rate for February. We can see the relevant chart in your screens right now. Moving now to JPY, and this would be USD JPY's 4-hour chart. Now, USD JPY has been rising as a consequence mostly of JPY weakening. You can see the first hesitant steps of the rise from the 4th of March until around the 10th, then a steepening of the rise, some slight stabilization, and it began practically a couple of days ago. We tend to maintain a bullish outlook for the pair as long as it remains above the latest upward trend line. To the upside, we note the 119.50, higher than that the 120.60, and the highest level would be the 121.65. To the downside, we note the 118.40. Lower than that would be the 117.50, and the lowest level would be the 116.30, which provided resistance here and has now been turned to a support line. Now, JPY is weakening for a second week in a row against the USD, tended to continue, and the pair has reached now levels not seen since February 2016. Note how the RSI indicator has reached or is about to reach the level of 70, implying that the pair may near overbought levels and may become ripe for a correction lower in the coming days, if not today. Moving on to the fundamentals of JPY overall, we tend to highlight the upside risk for inflationary pressures in Japan, not so much for February as for March and the coming months. Main reasons cited for such an acceleration could be the depreciation of the yen and the rise of oil prices and raw materials. However, the issue was more intense than we thought, given that inflationary pressures in the Japanese economy accelerated for February even more than what the market had expected, as was evident in the CPI rates release for the month during today's Asian session. On the monetary front, BOJ, as was widely expected, remained on hold at minus 0.10% in its interest rate decision earlier this morning, keeping its ultra-loose monetary policy intact in order to support inflation. Now, the bank in its statement highlighted the risks being posed by COVID and the war in Ukraine, yet sounded optimistic and expects inflationary pressures to increase in the positive territory. Should inflationary pressures increase, as mentioned before, it may become more difficult for BOJ to support its dovish narrative in the coming months, and thus BOJ's ultra-loose monetary policy may start weighing on JPY. As for financial releases in the coming week, we note on Thursday the preliminary Japan manufacturing PMI figure. That's for March. And on Friday, Tokyo's CPI rates for March as well. Note the upward inclination, both on the core level, the yellow line, as well as on the headline level, the green line, over the month of February. Should practically this tendency continue also into March, we may see the issue getting some more attention, given that the density of the population in Tokyo provides a substantial amount of the price change for the whole nation. Moving now to the common currency, and this would be Euro USDs for our chart, in a nice upward motion for the week, which seems about to be interrupted during today's European session. And should the actual upward trend line be broken, our first reaction would be leaning towards a bias for a sideways movement between the 1.1135 and the 1.1055. However, bearish tendencies could become present, in which case we may see the pair breaking below the 1.1055 and start aiming for the 1.0980. Lower than that would be the 1.0900, which provided some support back here. To the upside, and should the bull say enough is enough and regain control over the pair's direction, we may see the pair breaking above the 1.1135, which was tested yesterday, and aim for higher grounds, possibly the 1.1220, which provided resistance here. Higher than that, we note the 1.13, which was a support line twice. However, as the price action is below it, has now turned to a resistance line. The common currency seems about to break a losing streak of 5 consecutive weeks against the USD and continues its ascent higher against JPY from last week. On Euro's fundamentals, the war in Ukraine continues to be a big discussion among traders, as the possible adverse effect on Eurozone's economic outlook is more than just present. Now, negotiations for a ceasefire seem to be ongoing, yet hopes were dampened yesterday as the Kremlin practically denied reports for major breakthroughs in the talks with Ukraine. On the monetary front, the ECB seems to be postponing any thoughts for a possible rate hike. It's characteristic that ECB President Lagarde yesterday was reported stating that ECB has some extra space before its first rate hike, as the bank is in no hurry to hike rates, and also any move is expected to be gradual. As for financial releases, Euro traders are expected to have a substantial number of high-impact financial releases in the coming week. With a late start on Wednesday, we note the release of Eurozone's preliminary consumer confidence, that's for March. The highlight, though, of financial releases is expected to be the release of the area's preliminary PMI figures for March on Thursday. You can see the relevant chart on your screen right now. Note with the blue line, that's Germany's manufacturing PMI figure. Note the drop from January to February, which is somewhat worrying, and in contrast to practically the French services sector and the Eurozone's composite PMI, which may be spelling out some trouble, especially given the war in Ukraine. Now, other than that, we highlight the IFO indicators for, we highlight indicators for Germany's manufacturing sector, France's services sector, and for a more rounded view, Eurozone's composite indicator. Now, should there be a consistent rise of the figures, we may see the euro getting some support, as that would imply an acceleration of the expansion of economic activity in the area, and vice versa. Also, on Thursday, we would note the release of France's business climate for March, and on Friday, we note the release of Germany's IFO indicators also for March. Moving now to the Aussie, and this would be AUD USD's 4-hour chart, and a nice, beautiful upward trend line, aiming for the 0.7440, which provided resistance practically in the early days of March. Higher than that, we would also note the 0.7545, and even higher, the 0.7615. To the downside, we would like to note the 0.7365, which provided some support here, some resistance here, support resistance here. Lower than that would be the 0.7285, providing support here and resistance twice here. And lower than that would be the 0.7230, providing resistance twice, 3 times, and has now turned into a support line as the price action is above it. We tend to maintain a bullish outlook for the pair. There is one warning though. The RSI indicator is at the reading of 70, which may imply that the pair has reached overbought levels and may be practically ripe for correction lower. Also, please note that the 0.7440 had provided substantial resistance around the 7th of March, capping practically the upward motion of the pair back then. So we may see the resistance line holding its ground, in which case we may see a reversal of the current trend. On the fundamental level, a more risk-on attitude of the market seems to be supporting the Aussie, as do high commodity prices. Also, financial data for Australia this week were encouraging, as the unemployment rate dropped and the employment change figure rose substantially, in a clear sign of a tightening of the Australian employment market. The release could provide more confidence for RBA and a possible tightening of its monetary policy. The minutes of RBA's last meeting showed that the bank was already relatively upbeat on the domestic outlook, given that the tightening of Australia's employment market is ongoing. On the other hand, the outlook on the global economy seems to be gloomier due to the war in Ukraine. Also, on the fundamental level, we would like to note the rise of COVID cases in China and the lockdowns imposed in some provinces, among which also the city of Shenzhen. The Chinese lockdown was a painful reminder of how fragile the supply chains still are to any outbreak of COVID, and the disruption could now be expected that may have an adverse effect on the recovery of the Australian economy as well. As for financial releases, we note the release of Australia's market preliminary PMI figures for March. That's on Thursday's Asian session. Moving now to the Canadian dollar, and this would be USD CADs for our chart. In a clear downward motion, the CAD has been strengthening against the USD, just like the Aussie. However, the pair now in a downward motion has broken the 1.2660, which provided support numerous times, once, twice, 3, 4, 5 times in the recent past, and is now aiming for the 1.2560. If broken, could open the way to the 1.2455, and lower than that, we also note the 1.2375. To the upside, besides the 1.2660, which has now been turned into resistance, we also note the 1.2785, providing resistance once, twice, 3, 4 times, 5 times, 6 times. And even higher would be the 1.2855, providing resistance once, twice. For the time being, we maintain a bearish outlook for the pair. However, please note that the RSI indicator has reached the reading of 30, may have reached oversold levels, and may be ripe for correction higher. On the other hand, the lower Bollinger Band seems to imply that there is still some room for a further downward movement for the pair. Moving now to the CAD's fundamentals, it should be noted that in the past few days, the higher than expected CPI rates for February may also have contributed to the strengthening of the loonie. The acceleration of inflationary pressures in the Canadian economy could create additional pressure for the BOC to tighten its monetary policy even further. Please note that BOC is already rather hawkish. The situation is highlighted also by better than expected employment market metrics for February, which were released last week. It was characteristic how the employment change figure reached levels not seen since October 2020 that was that high, while the unemployment rate dropped, and both metrics aligned to point towards a tightening of the Canadian employment market in the past month. It should be noted also that the loonie tended to ignore the drop of oil prices in the past few days and continue to strengthen. Oil prices seem to have been on the rise since yesterday, after a warning issued by IEA that the supply loss would be far greater than an expected drop of demand, and thus could lead to a tighter oil market. Also, Ukraine and Russia do not seem to find common ground and thus intensify oil traders' worries. No high-impact financial releases are expected from Canada in the coming week. Hence, we would expect fundamentals to take over. And I would be highlighting practically 3 main sectors. The first would be interest rate differentials outlook, as expectations of the market for BOC become more hawkish, one. The second would be oil prices. The third would be a general market sentiment, which, if it improves, could provide support for the loonie as a commodity currency. That should be it. However, before we leave you, as a general comment, the FX market, it's expected to be a week ahead with a lighter calendar, allowing somewhat for fundamentals to increase their influence over the market. The USD is expected to maintain the initiative over other currencies, given the weight of the US financial releases. Nevertheless, still at certain moments during the week, other currencies may steal the spotlight from the greenbacks, thus creating diverse trading opportunities and a more balanced trading blend. Such examples could include the release of the preliminary market PMI readings for March, as well as UK CPI rates for February. On the fundamental side, the war in Ukraine still rages on, and it's expected to remain the main fundamental issue for the markets. Special focus could be placed on the ceasefire negotiations between Russia and Ukraine. It should be noted that sanctions on Russia are expected to grow even further, and it's characteristic that US President Biden is scheduled to talk to Chinese President Xi today in an effort to isolate Russia further, while Japan and Australia applied the new sanctions on Russian entities. Any signs of the two sides nearing a possible deal could provide some support for riskier currencies and outflows for safe haven instruments. However, worries could also be enhanced should the new COVID wave in China be extended, which could create turbulence not only for Southeast Asia, but on a global level. That should be it from all of us here at IronFX. Best wishes for solid trading.